we discuss a new chapter in the paper Financial Management today. And the chapter name is Cost of Capital. Now, what is cost of capital? Now, in the paper Financial Management, if we classify the area of a financial manager in two parts, then we find that in the one hand, the duty of a financial manager is to procure fund from the different sources. He may procure fund by issue of equity share, he may procure fund by issue of preference share, he may procure fund by issue of debenture, he may procure fund by taking long-term loan, or he may procure fund by taking short-term loan for the purpose of management of the working capital also. Now, this is the source from where he can collect the fund. Now, in what proportion of fund he will collect from, or he will collect by issue of equity, what proportion of fund he will collect by issue of debt or by taking long-term loan, etc. This is to be discussed in the chapter Capital Structure Theory. Now, so in the one hand, it is the duty of the financial manager to collect the fund from the different sources. And after collecting this fund, it is to be invested in the profitable project, and the main goal of a financial manager is to maximize the wealth of the firm. So, first duty of a financial manager is to procure fund from the different sources. Now, what is cost of capital? It is the rate of return that a firm must earn on its projected investment to maintain its market value and attract funds. So, cost of capital is the rate of return that a firm must earn on its projected investment in order to maintain its market value. Now, it is the average rate of return required by the investor from their investment. It is the average rate of return that is required by the investor from their investment, and it is also the minimum or cut-off rate of capital expenditure. So, cost of capital is the minimum or cut-off rate of capital expenditure. Minimum these rate of return are to be given to the provider of the fund in order to maintain the market value of the concern. If this rate of return, minimum of this rate of return, it is the minimum rate of return, if these rate of return are not provided to the investors, then they will dispose their investment. Equity shareholders will dispose their share if they are not getting sufficient return in the forms of dividend. Debenture holder will dispose of or redeem their debenture if they are not getting interest at the time. Preference shareholder will dispose their share if they are not getting the expected rate of return in forms of the preference dividend, and the expected rate of return, the minimum expected rate of return that is desired by the investors of the company in average term is called cost of capital. So, it is the minimum or cut-off rate of capital expenditure. Now, what is the significance of the cost of capital? Now, it is helpful in process decision making. So, helpful in process decision making. In order to making any decision relating to a process, we need to calculate the cost of capital. It is secondly, it is helpful to maximize the wealth of the concern. It is also helpful for determination of the capital structure of the company. It is helpful for making investment decision. It is helpful for making dividend decision. It is helpful for management of working capital also. So, in all of the area in which a financial manager has to operate for making of its operation, it requires to calculate the cost of capital. So, it is a very important and it is also a basic chapter of the paper financial management. Now, if we follow the classification of the cost of capital, that means how many types of cost of capital are there. Broadly, we can classify the cost of capital in 3 parts. Cost of capital may be classified from the viewpoint of the disclosure. It is to be classified in the view of the time pattern. It is to be classified in the view of the nature also. Whenever the cost of capital is to be classified in the terms of disclosure, then we have 2 types of cost of capital: explicit cost of capital and implicit cost of capital. Now, what is explicit cost of capital? It is the cost that is apparent in payment. That means it is evident by payment. And it is evident by payment of interest, it is evident by payment of dividend, and this amount of the cost of capital is called explicit cost of capital. Now, what is implicit cost of capital? Now, implicit cost of capital is that portion of the cost of capital which is not apparent in payment. Now, what does it mean? Means that it arises when a firm considered alternative uses of the fund raised. It is concerned with the alternative uses of the fund raised. It may also be defined as the rate of return associated with the best investment opportunity for the firm and its shareholders. They will forego if the investment are to be made in the project. So, explicit cost of capital may be defined. The cost of capital which is not apparent in payment, it is not evident by payment, it is rather may be considered as the opportunity cost. That means when a firm invests in a project, if there are lots of alternatives, then if the firm will make investment one of them, then on the other hand, he does not making investment in the other project also. And what amount of the profit, what amount of the cost that the firm has to forego by making an investment in a particular project, this is called explicit cost of capital. Now, from the viewpoint of the time pattern, the cost of capital again may be classified in 2 parts: historical cost of capital and future cost of capital. Now, what is historical cost of capital? Now, it is the agreed rate of return to be contributed of any given capital mix. That means it is the contractual amount of the rate of return that is to be provided to the fund provider. That means whenever the firm procure fund by taking loan, either in the form of debenture or in the form of long-term loan, there will be a fixed rate of return at the time of issue of debenture or at the time of taking loan. This fixed rate of interest is called historical rate of return. Similarly, whenever a firm issue preference share capital, the rate of dividend is always given at the time of issue. This is also to be taken as historical cost of capital. So, the agreed rate of return that is to be provided to the contributor of capital is called historical cost of capital. Now, what is future cost of capital? It is the cost of capital which is to be incurred in the future for obtaining capital from the different sources. So, it is to be considered in the future term. That means if the firm required further fund, if the firm required to raise further fund for making investment in the new project, then what will be the cost of raising this fund is called future cost of capital. Now, on the basis of nature, the cost of capital may be classified in three terms. Number one, specific cost of capital. Number two, marginal cost of capital. Number three, weighted average cost of capital. Average or weighted average cost of capital. Now, what is specific cost of capital? Now, specific cost of capital is the cost of capital of the specific sources. That means I discussed earlier that here the financial manager may procure fund by issue of equity share. Now, cost relating to equity capital is called cost of equity capital. Whenever the firm procure fund by issue of preference share, there will be cost relating to issue of preference share, cost for raising fund from the preference shareholder. So this cost of these particular sources, cost of raising fund from these particular sources are called specific cost of capital. Now, it is the cost of capital which is incurred for raising capital from the particular sources. The cost of each component of the capital is known as specific cost, such as cost of equity, cost of preference, cost of debenture, cost of debt, etc. Now,